Hello and welcome to this special episode of Death and Taxes, a weekly podcast by the private client team at Burgess Allen. My name is Guy Broadfield and I'm a tax and trusts lawyer in the private client team. And together with my tax and trust colleagues Tim Williams and Edward Hayes, we discuss a range of issues facing clients and professionals alike. Each episode, we'll be joined by specialist lawyers from around the firm to bring you our views on important topics for private clients. In today's podcast, Helen MacLeod and I are joined by John Barnett to discuss Rishi Sunak's second budget and how it might affect private clients. John is the head of the private client team and advises banks, financial institutions and high net worth and ultra high net worth individuals, particularly those with an entrepreneurial and international focus. Helen is an associate in the private client team and has a focus on clients with international interests.
Right, so we all know that the COVID crisis has impacted the country's financial situation in a way that we haven't seen during peacetime. The Chancellor did take the opportunity in the budget yesterday to put this into perspective, and noting that, for example, last year GDP fell by 9.9%, which is the largest annual fall in 300 years. And total fiscal support which the government has provided has now reached £407 billion. He did emphasise that we'll be paying for this for decades rather than for years. However, this budget did seem to be more focused on providing further support to the industries and sectors that are still struggling rather than necessarily raising revenue as its primary focus. But we are going to discuss some of the measures that he has implemented or will be implementing in the coming years. So from a private client perspective, there weren't a huge number of changes that were announced. He has frozen various personal allowances. So income tax personal allowance will increase to £12,570 on the 6th of April 2021, but will remain there until April 2026. And the high rate threshold similarly will move to £50,270 from April and then stay there till 2026. The inheritance tax no rate band has been frozen till 2026. And the capital gains tax annual allowance will do the same, as will the pensions lifetime allowance. The stamp duty land tax holiday, which people are making use of currently, will be extended to the 30th of June to prevent a cliff edge at the end of March, and then will taper down until October, so reduced to 250,000 until the end of September. But the biggest change from a private client perspective, or from the perspective of private clients who have interest in companies, is going to be the increase in the rate of corporation tax up to 25% from April 2023. But John, it would be useful for the listeners probably just get an idea of your initial thoughts as to the budget and sort of how you think the Chancellor came up with these policies and what you see going forward.
Yeah, I think a lot of the budget was trailed well in advance, so there weren't many surprises and it was pretty much in line with what we expected. He committed himself not to the triple lock on income tax, national insurance and VAT rates, so we didn't expect movement and didn't get movement on those. The corporation tax changes were fairly well trailed for a few weeks in advance as well, and perhaps only a surprise that they were delayed till 2023. So pretty much as expected. I think perhaps one of the more interesting parts of the budget is following the money. So certainly the biggest revenue raiser for him is going to be the corporation tax changes. When you dig into the policy costings, that's going to raise somewhere around 48 billion over the period through to 2026. That's the single biggest change. And then the next biggest after that will be the freezing of income tax allowances. That's going to raise around £19 billion. Beyond that, most other things are pretty small fry. So those, I think, were the most interesting things.
So, John, I mean, clearly there are a number of significant changes to corporation tax that are going to take effect from 1st April 2023. But it's worth pointing out that there are going to be a number of different rates that apply to different sizes of companies. Would it be helpful if you just sort of set those out and perhaps explain how these might impact private clients in the context of family investment companies?
Yeah, so they're going to revert broadly to the system we had pre-2015, where there are two rates of corporation tax, a main rate of 25% after 1st April 2023, and then a small companies rate of 19%. The 19% will apply to the first 50,000 of profits. The 25% rate will apply to all profits once they're above 250,000. And then to smooth the transition between those two, you get a marginal rate. And due to quirks of how the maths work, the marginal rate is actually higher than the 25% rate. It's we think it'll be 26.5%, but only on that band between 50 and 250,000. The other interesting part for a lot of private client situations, though, is that the small companies rate will only apply to trading companies and companies which let out property. For investment holding companies or close investment holding companies in the terminology of the legislation, they won't benefit from the 19% rate, so they will typically have a flat rate of 25%.
Okay, so there clearly are some tax considerations for those clients who might currently have family investment companies or are looking to set those up, and that affects taxation at the company level. But John, you made some observations about the changes that has to the effective rate when it comes to taxation of dividends from a FIC. Perhaps if you'd just like to explain that for the listeners as well.
Yes, so it's always been the case that when they're looking at corporation tax rates, they can't ignore the rate of income tax that gets paid on dividends as well. And for the last few years, rather than a 45% rate of income tax on dividends, you've had a top rate of 38.1% on dividends. That's supposed to reflect the fact that the company will already have paid corporation tax, such that by the time you add the corporation tax and the dividend tax together, you get to something that feels like the 45%. It's never been quite exact, but it's been there or thereabouts. Now, one thing they didn't announce here was any changes, and probably deliberately so, to the dividend rate of tax. What that means is that, strictly speaking, if the corporation tax rate goes up to 25, the dividend rate should come down from 38.1. But I strongly suspect it will stay exactly where it is. What that means is that by the time you add the two together, the combined rate is now quite considerably above the 45% rate. Very roughly, for every 100 of profits you earn in a company, the company after 2023 will pay 25. If you then distribute the remaining 75 and pay 38.1% on that, that's another 28.6, I think. So you get a combined rate of 53.6%, where profits are earned in a company and then distributed. And that's obviously quite well in excess of the 45% you'd have paid had you not had the company in the first place.
I mean, so really in those circumstances, you'd look really to a family investment company more as possibly as a roll-up vehicle. I mean, for those people who've got family investment companies already, I certainly wouldn't be panicking about this increase in the rate, not least because there's 2 years to think about it. There are lots of other good reasons to go on having family investment companies. There's all the estate planning things you can do around inheritance tax for profits that you don't need to take out of the company and you can just roll up within the company. You'll still only be paying 25% corporation tax rather than 45% income tax. So that's very useful. For any dividend income that comes into the company, again, you'll be paying 0% corporation tax still on those rather than 38.1% had you not had a family investment company. And of course, a lot of family investment companies are funded by loans in the first place, and you can take loan repayments without triggering any dividend tax at all. So still lots of good reasons to keep family investment companies if you've got them already. And probably still quite a lot of good reasons to go into family investment companies, although the maths has adjusted slightly, so it's definitely worth reviewing that.
Absolutely. Thanks, John. As we're going into this budget, I think quite a lot of people were concerned about the potential increases, particularly in capital gains tax. And there've also been in the last year or so the consultations on change to capital gains tax and the consultations on changes to inheritance tax. Now, we didn't see any of those changes being implemented in this budget, but could you give us your views on what you sort of see as the roadmap going forward, and any potential changes that we might be looking out for in the next few years that the clients might want to be aware of?
Yeah, so just because we didn't hear anything in the budget, particularly about capital gains tax and inheritance tax, other than the freezing of the allowances, doesn't mean they're off the table. One immediate thing that is definitely happening is that the Office of Tax Simplification, who've already produced one report on capital gains tax, do have a second report, which will be out in the next month or so, and that will go into a lot more technical detail about a lot of smaller areas of capital gains tax. And the Chancellor, I think, does have a statutory duty to respond to Office of Tax Simplification reports, particularly when he commissions them in the first place. So over the next few months, do expect more on that front in particular. We've obviously got the Office of Tax Simplification inheritance tax review they did back in whenever it was, 2019 now, which again, the Chancellor needs to respond to at some point. So don't expect either of those topics are off the table. But I think the interesting point here is that in the past we came to expect a big bang on budget day with all the announcements in one go. They're very much moving away from that and had already announced that this was going to be a three-ring circus this year. So not just a single budget day on the 3rd of March. We've got the finance bill being published on the 8th of March, although, again, most of that's been pre-announced, so I don't think we expect too many surprises there. But we've now got this further day called Tax Day on the 23rd of March, when they'll be publishing a lot of consultations and possibly some roadmap documents for the future. And I think this concept of a roadmap in tax is interesting. It's been needed for a while, really, a more long-term view of the tax system and really getting to the root causes of some of the problems we've got in the tax system. It'll be potentially interesting to see what happens on the 23rd of March. But in terms of actually taking a longer term view of the tax system, that's got to be a sensible thing to do overall.
And there are some interesting parallels there, John, aren't there? If you look at monetary policy over the last few years, it's been a central theme that the idea of forward guidance, to the extent that big changes are coming, that has been promoted or at least discussed by the Bank of England, and everyone broadly knows the position. And I just wonder whether at the moment that's the approach the government is deciding to adopt with fiscal policy. Of course, companies will have notice of the changes announced yesterday that are to take effect from 1st April 2023, and maybe that will be matched up in respect of announcements with regards to personal taxation. It remains to be seen what's announced on the 23rd of March, of course, but that possibly at least the days when big tax changes were announced and to be introduced overnight, maybe that's not where we are at the moment. Would you agree with that?
I think structurally that's the way we're going. There was a very good report from Mel Stride's committee. I lose track, is it the Treasury Select Committee, I think, published just about a week ago on tax after coronavirus, and they were talking a lot about a roadmap approach. It makes a lot of sense. I think one of the reasons we haven't had that roadmap sort of forward guidance approach more in the past is that tax has always been a heavily politicised issue, and long-term tax change, you really need to take a 5 to 10 year time horizon to get it right. And the problem obviously with that is that it doesn't fit very well with parliamentary cycles, particularly if you think that in 3 or 4 years' time you're going to have a government of a very different complexion. I think one of the reasons we might be at a point where we can now get more of this forward guidance is that the political landscape has compressed a bit, and there probably isn't as much between the main parties as once there was. So I think there's more of an acceptance now than even a couple of years ago that we're moving towards a phase of the sort of long-term economic cycle where we are going to have higher public spending, higher taxes generally, and more political consensus about that does give us the opportunity to sort out some of the long-term problems that have built up in the tax system over many years.
Thanks, John. So in terms of some of the other aspects that the Chancellor raised, we have a new Hmrc task force, which is being implemented. Presumably, this main focus will be to raise revenue. And do you have reviews to the sort of things it will be looking at and the sort of taxes it will be considering in more depth?
Yes, I mean, to an extent, it makes a lot of sense to the revenue. I think for every pound they spend giving the revenue more resources, they generally raise at least 10. So it makes sense for the Chancellor to do that. They've talked about employing 1,250 new tax inspectors. And in terms of revenue raising, I think it's the third highest revenue raiser as far as I can see after corporation tax and freezing the income tax allowances. They're slating it to raise about 3 billion over the next few years. Quite a lot of that, I suspect, will be in tackling things like furlough fraud, where they think that there's between 5 and 8 billion of furlough fraud. So even if they got back only a small amount of that with more inspection powers, that would be money well spent. But don't expect an easy life because the revenue will be looking at things in a lot more detail. However, if the extra spending means that you can resolve disputes with them more quickly, that would be pretty welcome all round, I think.
Absolutely. I think it's also worth flagging in terms of the stamp duty holiday that's been extended. There's no word, as far as I understand it, that that's going to have any effect on the new 2% stamp duty surcharge for non-residents purchasing UK residential property. So as I understand, that will still be coming in from April, whether or not the general stamp duty holiday is extended.
Yes, that's right, as far as we can tell. It's I suppose one of the aspects of a more of a roadmap approach to tax is that you no longer need just to look at what's announced in the budget. You need to remember what was pre-announced 1, 2 or 3 years ago. And yes, the 2% surcharge for residential property purchased by non-residents is going to come in, I think, from the 6th of April.
Great, so that's one definitely for private clients who are international to bear in mind. Another issue that a lot of clients have been concerned by is this idea that we might have a wealth tax or whether that's a long-term strategy or a one-off wealth tax or windfall tax on companies that have done well as a result of the pandemic. That again wasn't talked about by the Chancellor yesterday. But do you think it's fair to say that you can't turn away from that idea completely, and it's still a risk that could be implemented in the coming years?
I think probably under the current Conservative government, there is next to no chance of it happening. Rishi Sunak ruled it out pretty soon after the Wealth Tax Commission reported. But if you speak to the Wealth Tax Commissioners, they knew that even before they produced their report. So I think they had a slightly different agenda when they examined the case for a wealth tax. I think it was firstly with a view to a future Labour government. And although there's some uncertainty in Labour have at least expressed an interest in it. But more importantly, perhaps, I think one of the purposes behind the wealth tax proposals wasn't really that they expected a wealth tax to happen, but to open up the debate more generally about the way in which we tax wealth generally, whether that be inheritance tax reform, capital gains tax reform, even council tax reform. And I think the debate around the wealth tax has succeeded in that respect, in opening up that debate. So when we get to the tax day on the 23rd of March and possibly some consultations or roadmaps or forward guidance or whatever it's called, do expect wealth to feature in that, even though an annual or a one-off wealth tax probably won't be part of the specific solution for the moment.
And I suppose for the inheritance tax consultation, as you say, there's been a general discussion about how inheritance and inherited wealth should be taxed, and it seemed that the motivation for that consultation wasn't necessarily sort of to raise revenue in itself. It was more to look at the whole system and to simplify the whole system of inheritance tax, and readdress it, because it's quite an antiquated system, and there've been various bits that have been bolted on over the last 30-40 years, and so the motivation with that seemed to be to overhaul the whole system rather than necessarily just raise revenues, which means it's probably not off the table even if we need to focus on raising revenue for the time being.
I think that's right. Inheritance tax has never raised a lot. It's 4, 5, 6 billion pounds, which in overall government spending terms isn't a lot. Interestingly, on inheritance tax, there were 2 alternative proposals. There was the Office of Tax Simplification report, which was in a sense much less radical, much more in terms of tidying up some of the loose edges that you've talked about. But there was also the report of the All-Party Parliamentary Group for Inheritance and Intergenerational Fairness, which had a much more radical proposal for inheritance tax. Personally, I don't think it'll happen, but in lots of ways there was a good degree of sense in really radically simplifying inheritance tax, and in the process potentially raising a lot more money. So if they had the willingness to do it, inheritance tax could raise 10, 15 billion rather than the 4 to 6 it raises today. So don't rule out that they might look in a little bit more detail at that at some stage.
So if we take a step back from yesterday's announcements and take perhaps a slightly broader view, I think one of the things that I've noticed, particularly in the run-up to the budget yesterday, was just the level of anxiety amongst clients and in some cases advisors, which was understandable given the times we're in and potentially what might happen. But that's not necessarily new. I think it's also fair to say that there was that level of anxiety back in 2019 ahead of the election when there was the prospect of a Corbyn government. So, I mean, it's been the last couple of years in a sense have been marked by anxiety, and maybe that's just where we are. Maybe we're moving into an age of anxiety when it comes to tax policy going forward. I mean, John, would you agree with that?
I mean, I don't think anything has changed in a lot of respects. There's always been anxiety before every budget. Yes, possibly slightly more in the last couple of years, and possibly slightly more before this budget. But don't expect that to change anytime soon. Indeed, I think a degree of creative anxiety is probably something the Treasury quite like, because it triggers people to buy houses and get the property market moving ahead of any stamp duty changes. It triggers corporate activity, mergers and acquisitions. It triggers disposals for capital gains tax as people try and get in ahead of any supposed announcement. So I think a degree of creative anxiety is with us for a little while yet.
Great. Well, thank you very much, John, for joining us. It's been really helpful to get your views on yesterday's announcements and insights into what we might be expecting in the coming years. Essentially, it seems that we have a huge deficit to repay and nothing is quite off the table at this stage. So I think watch this space is the key point. But thank you very much for your time today.
Great. Thanks very much.
Thanks again for listening to Death and Taxes, a private client podcast from Burgess Salmon. You can find out more about Burgess Salmon and our team at burgess-salmon.com or on our LinkedIn page. Our next episode is the final episode in this series, and we're going to cover the issues for landowners to consider when selling land for development. So don't forget to subscribe. Thanks again for listening.